What's up, everybody? Monday, July 12th. It is Monday, so I sent out the new edition of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. Remember, I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT, and I show people how to use those things to invest and to trade in the financial markets. A lot of MMT academics out there. It's great. You know, let them write their papers, let them post their articles. But I take the knowledge of MMT, which is the concise understanding of the monetary system, and I show people how to use that to invest and to trade. Anyway, another record today with the market averages. So this has been kind of on repeat every single day. I believe the market now is getting a little speculative in terms of its level, and not just the level. I mean, I'm not necessarily ever really looking at the level of the averages. It's more about basic conditions, as I always say. And for me, the underlying thing that really is what drives basic conditions are the fiscal flows. That's government spending. Now, I've been telling you that these flows have been slowing down moderately. I mean, it's almost an imperceptible, no, I shouldn't say it's imperceptible, but it is a very modest slowdown. So look, it may not be something that's gonna, cause the market to pull back. I mean, when you look at the big picture in terms of, let's look at the deficit at 2.28, let's call it 2.3 trillion. I mean, that's, right up there with the largest deficit nominally that we ever saw. I mean, last year at this time, it was like something like 2.45. So last year was a little bit bigger at this time, but those are huge numbers. And again, when I say deficit, by now many of you know that, the way you should frame that, the way you should talk about that is net transfers, net income transfers from the federal government to the non-government. That's all of us. So that's a big number, and that is very supportive. But I look at that also in the context of how far the market has gone. And remember, the market is also factoring in expectations for earnings. And if you're having a reduced flow, it's 134 billion now, down below last year, the deficit is. If you're looking at a reduced flow, then ostensibly you should think that there'll be like a little bit, earnings growth will be a little bit slower. All right, we're in earnings season right now, so we'll see. I mean, there's some sectors that still look really, really attractive. Banks, for example. The banking data now is starting to look pretty good. I mean, trends are developing in a positive direction. Some of these loan segments that were in contraction for the last year, 14 months, 15 months, they're starting to pull back up into a growth trajectory, particularly consumer loans. I mean, consumer loans, if you look at credit card and revolving credit, if you look at automobile loans, very strong right now, coming back very strong. Even in the latest numbers that I saw on Friday, even commercial and industrial loans, which have been contracting still pretty sharply, they finally had some advance or some increase in the latest week. That was the week ending June 30th. That week was an interesting week because, and I talked about it in my last video, and I think the video before that, June 30th was interesting because we saw in that week the largest single week drop in bank reserves ever of all time. And I made a video about this because, when you hear people talk about, they're printing money. And, the banks have cash and they're going to lend it out. I explained it's actually the opposite. It's not the way it works. I mean, that 1 week drop in reserves, cash, all right, cash assets, that 1 week drop actually led to the biggest increase in bank loans in 4 months. All right, you had a 250 billion drop in cash assets on bank books. Like if you would ask all these other people about, they're printing money, they're going to lend it out, printing money, lend it out. Then you say, well, what happened there? You had the biggest 1 week drop in cash assets on bank books, and you had the biggest increase in loans in 4 months. So I explained the whole thing, in the last video. I talked about how, somebody asked me, like, why is that? Because banks have to have capital to back their assets, and when you have this huge increase in cash assets and reserves, it can slow down the rate of growth of other bank assets, particularly loans, and vice versa. When you saw those cash assets drop way down, that essentially created some space on bank balance sheets to increase their lending. They want to increase their lending. The other thing we saw was bank residual. That's basically their capital. That's assets minus liabilities. That shot up. The only thing I would say cautionary, and I think this would apply to the financial markets and risk assets in general, deposits. Bank deposits now, I believe 3 weeks in a row down, dropped by 128 billion. I always like to talk about bank deposits as, when people say cash on the sidelines, cash on the sidelines, there's cash on the sidelines. Well, it just dropped by 128 billion in the last 3 weeks. So, if you look at it like cash on the sidelines, some of that cash is dwindling down, all right? So I think some of the buying power to support the market rise, it's getting a little thin right here. So, look, you're in, I think, a squeeze to a certain extent, like a short squeeze in stocks. Those don't last generally. You need to have the correct basic conditions or conditions that are conducive, like when we were really, you can go back and watch all my videos from late last year or whatever, early this year, and I was saying, look, I mean, this is historic fiscal support. It's massive. You've got to buy every dip. You've got to buy every dip. But now it's decelerating. And again, look, the deceleration is modest, but I think if you look at where the market is right now compared to where it was at this time last year, and when you consider the fact that we are, 135 billion lower in terms of net transfers from the government into the economy, I mean, to me that says it's getting a little bit stretched, all right? It's not to say, we're going to have a market crash or anything like that, but it just seems like it's getting a little bit stretched. And again, this month, as a matter of fact, I think it's this week, Thursday, when those child tax credit payments start to go out, the 15th. So we'll have to see. I mean, we might see a renewed acceleration in those fiscal flows. But again, I see those numbers every single day. All right, that's like my compass. That's like my map as to where I'm going. That tells me where things are going to be. That tells me what forward conditions are going to look like, and that's what it's all about. I've said this so many times. It's not about looking at data that shows us what happened a month ago or last quarter. You got to look ahead. You want to know what the landscape is going to look like, a month from now, 3 months from now, a year from now. And these flows create the conditions that, will tell you what things are going to look like as we move out. So anyway, that's it. The other thing I saw in the CFTC numbers, interesting, gold producers in the week ending last Tuesday, what was that, July 6th, they were aggressive sellers, okay, short sellers, like aggressively short selling. And that's the first time in 5 weeks, the first time in 6 weeks that we saw them come in as sellers. They've been net buyers for the last 5 weeks. But last week, the 6th week, they were aggressive sellers. So when I see that, to me, that's at least a short-term top in gold. Same thing with silver, by the way. They were aggressive sellers in silver. I mean, that's a red flag. It doesn't mean like longer term, gold and silver won't rise. But I mean, right now, the producers, and they're the most savvy, let's face it. I mean, they know the market better than the speculators. They know the market better than I do. When they start selling, they are selling for a reason. They see supply coming on. They see a good high price to lock in, their profits. So you got to pay attention to that. So I think gold right now, silver right now, upside is probably going to be any more gains to the upside, at least right now, be a little tough with producers there selling. We'll see what happens in the next week or two, but right now, I mean, if you're long gold for a trade, I'd take a profit. Anyway, that's it for today. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.